I wonder if you think the Apple split will be more consequential down the road than we currently think. I mean, if you're buying the Qs, trying to ride the tailwind of mega cap tech, at least on a price weighting basis, does that become less powerful? Or maybe you don't believe that these companies will split the way Apple has announced?
We don't know that other companies will follow Apple's lead. You know, years ago when you bought a stock, there were commissions that you were paying. So if you were buying 10 shares and the commissions were $100, it could be significant. Nowadays, Schwab, Fidelity are not charging commissions. So the fact that you're buying 2 shares or 10 shares or 100 shares really shouldn't make a difference. We think in the Apple case, psychologically, people will all of a sudden look at Apple at $100 a share and get excited and probably bid it up a little bit more. So we think in that case, it probably helps that stock for a little bit. But longer term, it's going to be fundamentals, how their earnings are doing, how their new iPhones are coming out.
David, in listening to you make the argument value versus growth, I feel as though you could have made that same argument 6 months ago, even 6 years ago, and you wouldn't necessarily have been right. I applaud you for sticking to your discipline in terms of PE multiples, but I just wonder, are you just not in the proper place and time anymore as an investor?
Well, we're actually doing okay, but, and we do own Microsoft and Apple and Qualcomm that we bought at really good prices. So we're enjoying those moves. But there's a study that Bloomberg does where they look at the capitalization of the S&P 500 growth versus value. And if you look at that, we're now 4 standard deviations extreme. The last time we were this extreme was 1999. You were 2 standard deviations extreme. And I will tell you, in 1999, we were getting calls from friends, from clients that were basically saying, you know, you've lost your edge. You don't really know what's happening. You're the village idiot. And subsequently, over the next decade, the NASDAQ was basically flattened down, and the broader market was up about 6 or 7% a year. So enormous differential. So, you know, it seems to be that the growth stocks can only go higher. But having done this for 35 plus years, we know when you're paying 70 times earnings, you know, something not good is going to happen. And again, the caveat is companies like Microsoft, Apple, Facebook, whose businesses are pretty robust, we think are going to do fine, but we're just less optimistic about where Microsoft stock goes and Apple stock goes in the next year or two, rather than what it's done in the last year or two. We've had a great ride with them. We still own them. We're holding them. We just think that they're probably going to be okay, rather than other areas of the portfolio we think are going to be exceptionally good.